Hey everybody, I'm Andrew Levine on the Steemit team, the team behind the Steem blockchain protocol and the only blockchain-based social network with over 400,000 users that pays their users in cryptocurrency for posting content. Today, I am here with the CEO of Spectre, and we're going to do an interview about their platform and what they're doing, and hopefully he'll demonstrate the value of their platform. So, hi Kay, how's it going?
How's it going, Andrew? Thanks for having me.
So I think the first thing we should start with that will probably benefit the widest range of audience members out there, whether they're new to this space or not, is an exploration of smart contracts, because there's plenty of stuff out there about blockchains and cryptocurrencies. And smart contracts is one of those few areas in our field that's still kind of shrouded in mystery. Even the more sophisticated members of the community seem to view smart contracts as some magical cure-all to every solution. And we at Steemit, we actually think you can do a ton of the stuff people are claiming they can do with smart contracts just using bots and private keys, programming off-chain and integrating with chain. So would you mind speaking a bit about smart contracts, their utility, and maybe some of your novel uses of smart contracts?
Yeah, it's a fantastic question. So you're 100% right. I think a lot of what we've seen in the last sort of final part of this year has been motivated by how quickly can we as a project raise money, and how can we sort of redefine our project to make it fit into a round hole, although it's a square peg. What I mean by that is basically you don't need the blockchain for so many of these projects, right? As you rightly said, Steemit is using a hybrid approach. It's not 100% decentralized. It would probably hurt it if you guys became 100% decentralized, right? So, and we use a very pragmatic approach to that as well. Before I get into that, it's very important to note that if you're using an Ethereum smart contract, you need to be able to tokenize the underlying asset. And part of tokenizing it is also oracleizing it. There needs to be a provably fair way to actually distinguish whether an outcome is real or not, right? And that can't be centralized, that process. And the problem with a lot of smart contract usages of many ICOs is that they can tokenize the underlying asset, but they can't actually oracleize it. There's no independent third party that can verify outcomes. And then that kind of bit is just brushed over and people raise millions, right? And that the centralization problem is there. In our project, which is removing financial fraud out of trading in a retail trading scenario, there are two very important reasons or use cases of an Ethereum smart contract, right? And basically, to give you a quick background, we're a trading platform, the world's first, that has removed or disintermediated the broker out of the equation, but still retained two key functions of the broker. And that is basically A, providing liquidity, right? Decentralized liquidity, and B, also provably fair outcomes. What I mean by that is when you enter a trade, you get a price. When you exit a trade, you get a price. Traditionally, in a centralized scenario, that price is coming from the broker itself. So it's subject and open to manipulation. In our case, it's coming from a third party going directly into a smart contract, and that would be a third-party verification service like Oracleize, Towncrier, or another one. So it's very important that a smart contract receives this independent data to verify whether you, Andrew, have won your trade or lost your trade. And most importantly, it's the same smart contract that instructs the liquidity pool against which you trade to pay you out your wins, right? It doesn't instruct us, a bunch of guys sitting, a management team sitting in an office, paying you out your wins. It's actually done all via smart contract. So the human element in financial trading is no longer required. We have the tech today, Ethereum being an example, where smart contracts can retain all the important functions of a financial broker, but disintermediate and get rid of all the human functions which cause moral hazard, right? So I don't know if that kind of makes sense, but in a nutshell, tokenization without oracleization makes no sense, right? You need to be able to oracleize outcomes. Sorry.
No, I absolutely agree. And I think it's a fascinating point, and it leads me down a whole different area than I imagined we'd go. So first I'd like to start with a clarification, because I 100% agree with your determination of the importance of oracles. And people can think of oracles in lots of different ways, and essentially
Right.
it comes down to the human element, some kind of trusted evaluator.
Yes.
So I just wanted to clarify what your solution is for the oracle problem. Was I right in hearing that you're using another Ethereum based project to provide that oracle service?
Right. So there are multiple Ethereum-based projects. Oraclize is one of them. Towncry is one of them. Our team is currently evaluating which is the best one we're going to use. The most important thing is that when our trade smart contracts go live, they are open to audit on GitHub. Not the ones that are very sensitive to our IP, but the ones that are important for the traders to see that it's provably fair. There you'll be able to see from where the smart contract will be receiving the unfettered or the untouched quotes and price feeds. So you're 100% right. That is what we're going to be doing. And in the event that we find there's a lack of structural integrity with some of these Ethereum-based services, if we take a view that 5 years from now one of these won't be around, then we won't go with them. What we'll simply do is we'll go directly to the market maker, which actually creates the price feed data, and get that streamed directly into the smart contract, which is not in our hands. The smart contract is on the Ethereum blockchain. The most important thing is that those prices don't come to our trading application, which is an app, a web-based app, and go through us, because then we can potentially game the prices.
Who do you view as your demographic right now? Because if I was a trader, what I hear is it's provably fair. You can go in and look at it yourself. And I'm going, I'm a professional gambler. I'm not a coder. I'm not going to GitHub. Do you have systems in place that are going to guarantee that it's not just provably fair, but the provably fairness equates to a 99.9% probability that if X event happens, and I bet that it was and I placed a bet that it would happen, that I'm going to win my money and I'm going to get a bigger chunk of profits because I use your platform?
Yes, absolutely. And then the thing is that you don't even need to take our word for it. That's the beauty about the immutability of smart contracts. Once we create them, we unleash them on the Ethereum blockchain. You can't change them, right? And so in your example, Andrew, if you're a good trader, if you can hold a win rate over 60%, 58% over time, you can continue to generate return on capital in our system. And what a traditional broker would do, a B-book broker, is go all terms and conditions on you, block your account, put trade caps, and say, sorry, Andrew. It's what the house always does, right? If you win too much in a casino. So we can't do that because the smart contracts hold us true to that relationship. So yeah, absolutely. I would say more than 99.9%, 100%, unless there's a structural fault with the Ethereum blockchain, which becomes less and less likely as time goes by.
So if I'm a trader and I feel that a trade wasn't accurately represented, I can go back and look, and then I can come after you if the data was misrepresented or something?
Yeah, that's the beauty, because we have all the timestamps, the trade entries, the trade exits. We have the blockchain processing blocks, everything. All that information is published on what we call a trade ticket. So when the platform goes into beta, it's an alpha right now, you can try it on our website. When it goes into beta, it's connected to the test net. When it goes live to the main net, the user will be able to literally, upon click, get this diagnostic of each trade, and then they can literally complain, right? Because there will be complaints. People always say, oh, well, that trade won by 1 micropip, but the price was different. The beauty is that both what they have and what we have is coming from an independent source. So we can say, well, according to this source, it was right. So yeah.
Right. And that really highlights one of the benefits of this technology as a whole. It's like this turnkey third-party arbiter, this neutral third-party arbiter. That's really the service the blockchain provides. It's definitionally and provably independent of any single person. And in fact,
Absolutely.
Thousands and thousands of people have to agree that it's accurate before it can be updated.
That's so true.
I did want to continue this conversation because I think we've touched on a really fundamental, this can really help accelerate people's understanding of the state of the art in this field, because most people aren't even talking about this issue of oracles, which I think dovetails into another issue that I've been talking a lot about lately, which I refer to as distribution mechanisms. But they're intimately tied. And so you have a lot of people out there, a lot of those people that we kind of alluded to, who are just kind of trying to fit their square peg into a round hole in order to raise
Right.
money, where they're creating these tokens and they go, well, look, we created these tokens. Isn't that great? Like, it's hard to create tokens. Now, the hard part is distributing them. And that's where the issue of oracles comes in. And they're this layer, this distribution layer. And where you, the case that you're talking about is where you really need a human layer or some other layer, like you talked about the price feeds coming in. Those have to be off the Ethereum chain. And so what it sounds like you're doing first is you're going, okay, we need people with access to price feeds who are accountable, and we integrate the information coming out of those people to determine our distribution mechanism, to guide our distribution mechanisms. Is that fair?
Absolutely. That's absolutely fair, because the gaming of price feeds, which is known as price quote manipulation in the industry, it's a rampant problem. If you just type in retail trader price manipulation or price manipulation in financial trading, it's a multi-billion-dollar problem, right? Because this is the way traders will get an edge as well, on the spread, on delayed entries, latency. These are the games they play. So the oracleization in a financial trading scenario, the use case for it is very strong. It's very, very important. Now, we can build our platform without it, obviously, right? We can say, hey, we don't need to oracleize, just take our word for it. We have a decentralized liquidity pool. You don't need to deposit. Those are already two very big pluses, right? But we're going one step further and saying, look, we're also oracleizing our outcomes. And because it doesn't really slow down our processing capability in terms of trade outcomes, it's not like we become a low frequency trading platform because of oracleization. We can do it, so we're basically hedging ourselves in case there's ever a dispute. They say, okay, we won this trade. We can say, well, actually, no, you didn't. This is what the data shows as per a third-party auditor. So
the other interesting thing that you made me realize with respect to oracleization and these distribution mechanisms is an interesting way of explaining how we manage the process, because we effectively crowdsource oracleization by determining payouts based on stake-weighted upvote. And so we're using the Steem account holders and their upvotes to determine who gets how much from the reward pool, which I guess is analogous to your liquidity pool.
Absolutely. And it's a smart idea, because you guys need to use some sort of, if you can't have financial data, which is mathematically verifiable, right? Plugged into a smart contract, which then deems the payouts on the Steem platform. It wouldn't make sense, because your payouts aren't determined based on financial price feeds. You're using the user experience nodes, right? You're using the decentralized voting mechanism, which is the only way to do it, and it's a good way.
Yeah, for subjective valuations.
Exactly.
So, well, thank you for that insight, because now I feel like it'll make it a little easier to explain. I also wanted to highlight that we're actually currently working on an Oracle white paper, because we're launching a new protocol that's going to launch on top of the Steem blockchain called Smart Media Tokens, that are going to give anybody the ability to launch their own Steem-like token with thank you. Yeah. And 3-second transfers, feeless transfers, and some additional features, like there's going to be an ICO smart contract baked into it. So if you do want to raise some capital, you could do it. But one of the things we want to release alongside that is an Oracle white paper. So if you have any interesting insights that might contribute to the conversation, I'd want to get you in on that, because oracles are going to be hugely important going forward.
It would be my pleasure. Absolutely. Definitely count us in. We're also looking for Oracle services as well. We want to diversify our oracles as well, instead of just using one. So definitely, if that is something you offer, we'd be very interested also from a service standpoint to take a look. Thank you.
Sounds great. All right. So my next question would be, aren't there already applications running on Ethereum like yours, like Stocks, like Augur? How is your platform different from them, if it is?
That's a fantastic question. So the answer is twofold. Basically, firstly, neither Stocks nor Augur have a decentralized autonomous liquidity pool. They are purely P2P, peer-to-peer, or they are purely B-book. You're trading against the broker directly. Now, I'm going to let you guess which one is doing which. I want to make this challenging, but generally speaking, the problem with peer-to-peer, solely peer-to-peer prediction markets is liquidity. Go to one of these platforms, go to any prediction market today that's only peer-to-peer, and the big problem you will face is you won't find a counterparty to take your other side of your trade. So if you're shorting, let's say, Ethereum versus US dollar, right, purely synthetically, or if you're going long euro versus US dollar, you need someone on the other side of the trade, right? And these services don't have decentralized liquidity pools, basically bags of money that will take the trade in case they can't match you against another peer. That's, in my opinion, is one drawback. The second drawback, of course, is you don't have the range of contracts we do. We have smart CFDs, we have traditional A-book trading, we have smart options. So those are two big things. Now, one of the services you mentioned requires you to bring your own liquidity to the game. So not only is it enough that they convince you to join and trade with them, but also they ask you to create a market. So you have to bring your own liquidity, and then when you create a market, you get a small percentage of the fee. Whether that works or not, it's an academic exercise. What we know as financial traders who've been in the trading sphere for over half a decade, traders don't have time to bring liquidity to the markets. Traders just want to come, they want to deposit money and trade, right? And they want to make money and they want to leave. That's how simple it is. So you need to provide the liquidity for them. In my opinion, this is where our platform stands out. And there are kind of other sort of tertiary things we can discuss, how our platform is different. For example, we're the only platform in the world that's using this decentralized autonomous liquidity pool as a protocol. So we are already in talks with e-commerce companies, fintech companies, betting companies, sports betting companies that are looking to create apps that will connect to our pool, because the middleman risks that we address effectively through this decentralized autonomous liquidity pool protocol, which is oracleized as well, effectively can be done in other adjacent fintech industries as well, not just financial trading. So our DApp store, our DApp hub, is a big part of our long-term investment case, which is unique in the industry at the moment.
To clarify, you're developing not just an application, but a protocol on which you will launch multiple applications, and other people will be able to launch applications as well?
More importantly, other people. So our team as a focus is, of course, on the financial trading platform, because this, goes back to another thing, is what's wrong with the ICO space is sometimes management teams just want to do everything at the same time. It's really irritating. They've raised, 20, 30 million, on one premise, and now suddenly they've just pivoted and they're doing something else. And that's very annoying. So no, we will focus on financial trading. It's a huge market. It's, to quantify, it's almost 10 billion a year, our addressable market. But there are a lot of other management teams. We've just signed an MOU with a major e-commerce group in the US. They do around 8% of eBay's turnover in drop shipping every year. Our decentralized autonomous liquidity pool is going to be participating in their transaction volume. So that's an example of using the DApp protocol outside of financial trading.
Well, that makes me wonder, who are you guys? What is your mission? Who's on the team? What's your background, and what are you trying to do?
Sure. So basically, all of us, none of us are really marketers or affiliate marketers, so to put it. We are all financial engineers, statisticians, mathematicians. I myself, it's more equity research-based background. So I was basically a stockbroker, but more on the research side. I worked at JP Morgan and Goldman Sachs for around 7 years. And then I left and started my own fintech company here in London. We built our team. It's around roughly 9 of us right now. We've expanded recently a little bit. And we're basically, for the last 4 years, the business we've built here is focused on financial education, teaching traders how to trade safe, how to avoid the common pitfalls of trading, and algorithmic software that we've been creating for traders to help them spot safer, better trade opportunities. And basically the feedback that we were receiving over the past 3 or 4 years is, hey, we're getting scammed left, right, and center, right? This B-book trading fraud is rife across digital options, foreign exchange, and a range of other industries. So our backgrounds is pretty boring. We're just, financial engineers, and there's a big problem in the industry that we're solving now using the Ethereum blockchain.
Boring is good in this field. It's stable, it's safe. I like hearing that personally. You mentioned kind of the ICO fundraising. You're now nearing the end of your ICO. You've raised a
Yes.
good amount of money. Um, I wanted to specifically talk about some of the incentive mechanisms that you have built into your ecosystem. There's some kind of 2% dividend. What's that? That kind of sounds like a get rich quick scheme. You know, buy our token, you're going to get
Yeah.
2%. Is that annually? Is that what's the deal on that?
No, it's a fair point, especially given you have all these lending schemes, you have all these, arbitrage robots that make you 10% a day. And no, so 2% we think is a relatively fair and sort of moderate demure amount to pay our token holders that help fund the ICO, that help fund the project, that most importantly help fund the decentralized autonomous liquidity pool, which is at the engine of our service, right? Our engine of our growth. So it's a 2% volume fee on smart option contracts. So if you take a $100 trade on our platform as a smart option, $2 would go to the dividend token holders. We also have a utility token, which is not a security. That's for the people that can't invest in security-based tokens. That's more for the traders that unlock certain privileges on the platform if you hold it. But the dividend token, you're right, is a pure volume play. As we put more traders on the platform, as the liquidity pool grows, so does the dividend amount paid. Now, in answer to your second question, the frequency is actually weekly, so it's pretty dividend intensive. Users can log into the platform, withdraw the dividend. It's all paid out via smart contracts anyway. Excuse me. And then there's an end of year dividend as well, which is paid based on the growth of the entire liquidity pool during the year.
That does sound like a healthy implementation. You got to incentivize the right behaviors, and that's
Yes.
part of the cryptocurrency element to the blockchain game that I think a lot of people don't understand, is that there's a fine line. You can't do nothing for your
Right.
stakeholders, and otherwise it actually makes the system more gameable. So these mild incentives, or I mean, actually 2% a week is pretty solid, but it's effectively pegged to your volume. So
Exactly.
so it still sounds pretty sustainable. And of course, you plan on growing the platform over time and the number of people using it over time. But even if it shrinks at any point, it's still sustainable, that dividend. It's just going to be less.
That's the key thing, right? So we aren't promising any 10% a week or anything like that. If the volume's slow, the dividends pay out slow. If the volumes accelerate, they accelerate. That's the most important thing. You hit the nail on the head. And more importantly, we're kind of outsourcing our growth as well because of the dApp Store thing I told you about, right? The dApp Store opportunity. The other management teams that create apps that plug into our ecosystem, they will also be pushing users to their platforms, which directly translates to more volumes in the pool. So we want to have many engines for growth, not just ours, and that's kind of a key differentiator.
Yeah, that's a really interesting point. That highlights one of the things I look for when I'm investing in this sector, which first of all, I almost never recommend people do. And if I do, it's, assume maximum risk, maximum volatility, risk of going to zero. But
Yes.
with that out of the way, I'm always looking for protocol coins like yours, like ours. We are incentivized to make our protocol as flexible and useful for third-party developers as possible, because we're all united by Steem. And so that's part of the reason why we love the other platforms that run on Steem, like DTube and D-Mania, which is a meme platform, and like there's more all the time, because at the end of the day, we're Steem stakeholders. All of our users are Steem stakeholders, and it actually sounds like your platform is a really tightly analogous. Not that I'm accusing you of copying it, but where the traders get to unlock these privileges by participating and earning your utility token.
Yeah, absolutely. I mean, look, the thing is, I think it's almost like we're in parallel universes. We're kind of addressing different issues in different industries. And because our pool is more it only steps in, whichever app it is, right? Whether it's financial trading or it's invoice factoring or if it's e-commerce, it's only stepping in where there is actual risk of loss. That's the most important thing, right? So it's a conditional wager. Wherever there is sort of risk of loss in the insurance industry, where there's risk of loss in a financial trading scenario, and where there's middlemen that accelerate the loss, whatever, that's where our pool steps in. So I think we're kind of, I think it's a very interesting journey, because you're right, I don't really see any competitive overlap at all. I find your idea about the Steem token, which allows private people to potentially do private ICOs, so to put it, kind of, right, to raise funding through the ICO element, which is amazing. I think that's something the space needs as well. And you have 170,000 users plus, if I'm not wrong, right, already using.
Actually, we're closer to 500,000 users.
Wow.
With like 30,000 daily active. Yeah.
That's incredible. So that's validation that a concept like that works so well, right?
Yeah, we're very happy with the platform and our users and our developers and how things are moving. It's great, and being part of the team is awesome. I try not to talk about it because it sounds like I'm selling it. So I want to maybe we can finish on, or we can keep the conversation going if you got the time, whatever. You're nearing the completion of your ICO. Do you have any thoughts on doing on how to perform a successful ICO now that we can say it has been a success, or any other thoughts on the ICO craze that's happening right now?
Yeah. So the advice I would give is, we took the advice from the CEO of Pillar, which is doing the independent data management wallet. They raised over 21 million. The guy is called David Siegel. He wrote the ICO handbook, and he wrote that, I think, 4 or 5 months ago. And for me, it's the ultimate primer on how an ICO should be done, right? I mean, give or take a few points, I would say 80-90%. It's really, really well written. We've followed the advice almost to a T. And as a result, we've had a pretty successful ICO ourselves. And the advice I would give in a nutshell is make sure you get your costs right. The ICO market has become very expensive. You can't do an ICO for 100K anymore. That figure is outdated, unless you go viral for some reason. The cost of advertising has shot up 5 to 10 times. So it's more expensive, and most importantly, get a good community manager on board. That is a key determinant of success. And finally, just make sure that you are definitely covered in terms of your use case for the blockchain, because investors have become way more savvy, more smarter. If we didn't have a good use case, people would say, well, why you when I can invest in Steemit, right? Because Steemit has a use case, proven use case, et cetera. And not only Steemit, but there are other good quality companies out there that have created a lot of traction. So investors have they're more spoiled for choice rather than 1 year ago. So make sure your use case for the blockchain is good, but definitely read that primer, the ICO handbook. That's very, very suggested.
Yeah, I absolutely agree with all those points. I've gotten some white papers lately where I'm looking at them like, this doesn't have to be on a blockchain. This is vague. Yeah. You're clearly trying to raise money and then figure out your model. And then they don't raise the 100 million or 10 million or anything that they were expecting. And they're like, why? What did we do wrong? And it's like, everything. It's not a good product. It's not a good idea. You don't have a strong team. You don't need blockchain. You're not blockchain people. And I'm always looking out for blockchain people. And we can smell our own and beware, because we know one another. And through talking to you, it's become very clear that you are blockchain people, and that it sounds like you guys are offering a real product that solves a real problem. And I look forward to seeing how it progresses. And
I appreciate that.
I think that's a great place to end it. I want to thank you for experimenting with this new format that I'm trying out, and I think it went great.
Thank you so much for your time, Andrew. Really enjoyed it, and look forward to seeing you on the other side. Congratulations to Steemit as well, and I think I should probably go and buy myself some Steemit shares, tokens.
Only if you want. Have a good one. We'll talk soon.
Thank you, Andrew. Have a good one.